Welcome. This video explores segmentation examples for banking, and it is a part of marketing strategy. Let's look at the first example of a market segmentation for banking. Okay, so you can look at the total market and segment them. One way is this way: non-customers, low-value customers, medium-value customers, high-value ex-customers. So please pause me for a moment and consider the question: which segmentation variables are being used? Which major category are for: geographic, demographic, psychographic, or behavior, and which specific segmentation variables are being used? Okay guys, so here we're using customer value segmentation and also customer relationship lifecycle. Both are a part of demographic segmentation. This is probably one of the easiest approaches to segmenting a market for a bank by looking at customer value segments and progression through the customer relationship lifecycle. So let's just describe each of them. Non-customers. These people never dealt with a particular bank before. They primarily consist of customers who might be using other banks, as well as younger customers who are yet to form the first banking relationship. These customers are frequently targeted by banks primarily interested in expanding the size of the customer base with the intention to grow the value over time, so they are prepared to wait. Non-customers who have relationships with competitive banks might be interested in special offers and deals, provided that they are either shopping around for a major purchase, for example, new mortgage, or are currently dissatisfied with their existing banks. For example, HSBC have been running the promotion campaign for quite some time, where they offer £150 to £200 for switching accounts. Non-customers are also younger customers who are sometimes targeted by banks, by school saving programs, in an attempt to kind of like secure their long-term loyalty. Now, low-value customers. There are two groups of low-value customers. The first one would be customers who have limited income and or limited need for financial products. It's likely that this type of consumers will only ever contribute a low level of profitability to the bank. Therefore, it is important that this long-term value market segment is an important target market for any bank. The second group of those low-value customers would be those who diversify their financial products across different financial institutions. For example, they may choose to have their £100,000 in savings deposited across a few different banks. This group of customers will generally provide a very low profit contributing to an individual bank. They do provide some potential to be a medium value customer if the bank can win greater share of the wallet in the future. The challenge is to convince these risk adverse customers to be willing to place most of their kind of wealth with one bank. The other category is medium value customers. They also fall into two categories. The first one are customers who have a majority of the bank with the financial institutions and therefore have limited potential to become a high value customer. The second group will consist of people who have significant financial business with other banks, possibly because of special offers or the preference to diversify their accounts. High-value customers have larger deposits and loans with the banks and form the basis of the financial institution's ongoing profitability. While they may be more costly to retain in terms of additional customer service and special deals, the overall profit contribution is highly attractive to most banks. And ex-customers. These will be customers that have either become inactive or have stopped using the bank or may no longer deal with the bank at all. While theoretically representing a potential opportunity, this is a hard market to re-engage with, and that's because consumers have trialed the bank but now choose to place all their, say, wealth with other institutions. Occasionally, this is due to a change in personal circumstances, for example, changing needs of some level or dissatisfaction with the bank. So you may wonder at this stage, what does it mean for our targeting strategies? Well, high-value customers typically require relationship marketing tactics. Medium-value customers can be pursued with special offers and direct marketing programs, while low-value customers essentially need to be targeted through general advertising, corporate communications, and low-cost internal promotions. So as you can see, you would cater and tailor your marketing programs in order to address each of their customers. And just to add that while this is a significant simplification of the customer relationship management tactics required for each segment, it does highlight that the market segmentation process is sometimes used to guide marketing programs rather than to profile the segment itself. Let's look at the number 2 example for market segmentation for banking. Okay, so we can segment people into starting out, double income, no kids, first home buyers, established families, retiree. So this is another example to segment. In this market segmentation example, the concept of the family life cycle is being used primarily. Family life cycle would be the stages that individual typically goes through over time in their life as they move in out of relationships and probably start a family. In previous years, the family life cycle was reasonably structured and quite predictable. However, in more recent times, people can go through a variety of life cycle stages depending on the personal situations and changes. Regardless, it's still quite a useful form of segmentation for banking, and it's quite predictive of the financial needs of each of the segments as they progress through life stages. Please note there are various ways of structuring a family life cycle segmentation, but in this approach, 5 market segments have been identified, such as starting out, double income, to retiree. So starting out, this segment consists of people who are typically older teenagers or younger adults who are starting out their career. At this stage of their life, they only have a need for relatively simple financial products such as transaction account and perhaps a credit card, or a few. From time to time, may need a small loan or will have a small amount of money to invest. In terms of family life cycle stage, they are either single or not in a serious relationship and usually do not have the need for sophisticated financial products to make larger purchases. Double income, no kids. This is the next stage when the consumer forms a serious relationship or perhaps get married. This will trigger the consumer needs to start saving more money, looking for short-term investments or investing in shares and stocks or maybe crypto, or borrowing larger amounts to perhaps purchase a motor vehicle or go on a major holiday. At this stage, there are no children in the relationship, which may never happen actually, which also means the couple can continue to rent without emotional pressure to purchase a house. First-time buyers consist of people who are usually in serious relationship or married and now have young children. It is when families start a family that the financial needs significantly change. Indeed, many of the regular purchases also change significantly. This life cycle change is quite important for a bank as the young family is usually more motivated to purchase a home, which will transform the customer from being a low-value customer to a medium or high-value customer for one large mortgage, for example, transaction. Established families would have older children and usually have both parents working, either full or part-time. At this stage of their life, they're either starting to build some wealth or significantly pay off their home. Their needs typically shift from loans and mortgages to savings and investment accounts, and perhaps even share investments and possibly business loans. And finally, retirees. At the end of family life cycle would be retirees. These are the customers, those children have left home and they have stopped working, which means no longer derive any income from employment. As a result, there is limited potential to increase their attractiveness to a bank, but they are key targets for long-term and loyal business. Generally, their financial needs shift from loans towards retirement accounts and saving products. I would also suggest just to take a moment and compare those 2 segmentation examples that we have explored. This one specifically focuses on family life cycle, whereas previous one focused on more wealth and life cycle. Well, at the end of the day, you can say they are kind of interlinked. And I also digged out what market segmentation is being used by one of the leading banks in the UK, Lloyds Banking Group. And they actually employed a company called Fresco, who provides financial services segmentation. So, Fresco is the UK's one of the leading individual level financial services segmentation that groups the entire UK adult population into, in this case, 12 different segments, and see if you can find yourself. 51 sub-segments, and 124 micro-segments. So can you see how much of a project it can be to segment your customers? So here we look at the categories we identified: still at home, starting out, rising metropolitans, poorer parents, working single couples, down to low income elderly. So again, you can see that the combination of different segmentation variables is being used. A lot of them come from demographics category, where you look at the wealth, at the age, life cycle, and so forth. But this is just really to illustrate how seriously perhaps companies are taking this and hiring other companies to provide professional services in terms of a segmentation. And then they would design particular targeting programs to address those customers. Thank you very much for watching. Hope you found it useful. If you like the content, please hit the like button and subscribe to the channel so you can be the first one to get all my newly released videos. Thanks again.